Get off the sidelines and take control of your financial future at www.tackletrading.com. Get in the game.
Matt Justice here for Tackle Trading to bring you the market prep video for the week of Monday, June 29th. We have a lot to analyze here, so let's get right at it here. Obviously, there is an absolute tremendous amount of information that's happening out there in the marketplace. Anything from the ECB to the IMF to the Eurozone to the Greece situation to the Greek referendum, and just to let everybody kind of be aware of kind of what happened. Now, this all started back in 2011. It was really kind of the July, August of 2011, and basically on August 7th, August 8th of 2011, you had Greece come out and we started seeing really the depth of that Greek, not only the Greek debt situation, but really just the Eurozone and really kind of in the world out there as well. So what we're going to look at here is we're going to look at the marketplace when that first happened, because I do believe we can assess and we can learn from the past marketplaces when we dealt with this type of volatility before. And so right here is the 2011 year. And so as you can see here in August, it was really that second week of August, this is when the Greek situation really hit us hard. Now obviously we were starting to slow down right here. That was based on quantitative easing 2 coming out of the market. So we started slowing down based on the quantitative easing 2 scenario, and then that Greek situation comes out first in light here, and look at that, just massive spike down. Now these are weekly charts, so the volatility is kind of smoothed out here, but this is the ES contract. But when you were looking at the Dow was swinging 400 points daily, down, up, tremendous volatility, and as you can see, just tremendous volatility. Now here, what kind of put a stop to it was, number one, they bailed out Greece. And one of the ways they bailed out Greece was what we call the dollar swap. And so the Central Bank of the United States announces this Operation Twist, where they sold short-term bonds, bought long-term bonds in a way to manipulate the bond market a little bit. And then they announced the dollar swap issue, where basically, and that was right here when they finally put a bottom in it, where they basically sent US dollars over to the Eurozone in exchange for euros, which without a swap rate attached to it. And so you basically had the dollar swap and the Operation Twist that really kind of put a stop to what was happening here. So we have this, now we have this in mind. Let's kind of go fast forward in time here. And let's just look at this year right here. And so now this is the marketplace this year. And as you can see, the marketplace was already slowing down even before what happened over the weekend. And so it was slowing down because quantitative easing 3, which was called QE infinity, that kind of came out of the market right back into this this little scenario back here, and then it starts to slow down, and you have a little bit of a head and shoulders action here. You got a little bit of an M formation to a certain extent, but all of a sudden now you get this same type of news that comes out over the weekend that Greece and its creditors, the IMF, Germany, and even to a certain extent the United States. Greece owes the United States creditors about 12-13 billion dollars. And so when you're looking at this overnight, the marketplace gaps down. Now if you look at it for a second, we'll look at just today's price action. Look at that. Look at that movement to the downside overnight. This is last night when the markets opened up. It literally went from about the 2095 all the way down to 2054 at the low point. You had a 40-point clip in the marketplace at the low point, and that was overnight. Then obviously it's been inching up a little bit, and that's to be expected. We see that quite a bit, where you have some tremendous news to the downside, then you have movement back up to the upside. So in looking at this, I basically, it's going to be interesting to how the central banks in the world respond to this latest crisis. It's been widely expected that the United States Central Bank is going to raise interest rates in September. Most people are saying that's done now. Most people are saying the United States cannot raise interest rates when the world marketplace, the world economy is struggling so mightily that if they raised interest rates in this environment, it would be a Lehman Brothers type catalyst, and I think it would too. I have a tendency to agree with that. So one thing that I'm struggling with is, can the central bank, can it keep the marketplace up? I don't think it can drive it higher. I don't know. I think that's going to take a tremendous amount of quantitative easing to drive the marketplace higher. But can it keep it up? Because if they don't do something, the market will sell. The market will start moving down. You will see that correction that we've been waiting for a couple years now in the marketplace. So it's going to be interesting to see how the central bank handles the interest rate discussion over the next little bit. But also there's some chatter out there that not only can the central bank not raise interest rates, but are you going to start seeing QE4? And I think that would absolutely be disastrous, ladies and gentlemen. The market needs to sell. The market needs to correct back down. The market needs to go down 30, 40, 50% just to get back to a level to where we can start buying again, because it's very difficult to be a strong, heavy buyer in this environment where we're so overvalued, where we're so overinflated, where nothing in the marketplace matches what's happening in the real economy. And what they're doing is just they're constantly kicking the can down the road. And I think ultimately, ladies and gentlemen, what you're really kind of faced with right now in the marketplace and I think this is the biggest risk out here. It's not the market going down, guys. It's not Greece defaulting. We can handle that. We can get over it. We'll always move on. Okay, the market always does. The biggest risk that every one of these central banks are doing, to the ECB, to the BOJ, to the FOMC, they are putting tremendous amount of pressure on the fiat currency system as a whole, and that is the biggest risk. And when you're printing so much money just to prop up a marketplace, and think about this, guys, we're printing so much money just to prop up this marketplace, just to see it so it won't correct, but you're printing trillions and trillions and trillions of dollars. You've already printed close to 5 trillion US dollars. You're printing 1.1 trillion, 1.1 trillion euros, and you're also printing about 240 trillion yen, which is the equivalent of about 3 trillion US dollars. When you're literally creating all of this fiat currency out of thin air, it's going to have disastrous impacts long term. And I think we need to start, and we have to prepare for that to a certain extent. We have to prepare for certain amount of black swan type risk levels, because if the central banks fell in what they're attempting to do right now, and guys, they are failing. Look at the economies out there. Look at the debt burdens out there. This is not just a Greek situation. This is a world problem. It's not even just in the Eurozone. It's a world problem. And when you continually print against the debt, when you continually print to bail out Greece, when you continually print to prop open and just fight to keep financial markets up at high points, all you're doing is you're putting tremendous risk, tremendous uncertainty, and potentially death of currency type scenarios. And so that's kind of what we're seeing right now in the Greek situation. Now, fast forward till today. Okay, on June 27th, this was last week, on June 27th, Greece announced a referendum basically to be held concerning the bailout. It's going to be held on July 5th. They don't even know if they have the money necessary to hold the vote, ladies and gentlemen. That's how bad that Greek situation is. On June 28th, the Greek parliament approved the referendum, and so on 27th, the government announced it. On the 28th, they approved it. It will be held in terms of till July 5th. Now, they also, in that same type of scenario, they also basically announced that Greek banks will remain closed. You have no access to capital. You have no access to money in Greek banks. International people that are traveling, they still have some limited access, but the Greek people, the Greek banks, there is zero access to that. And just think about it, ladies and gentlemen. If you shut down U.S. banks for a week, what would the U.S. consumers do? They would riot. They would riot if they had no access to money. And that's what's happening in Greece right now. Right now, I'm putting it about a 50-50 coin flip if Greece leaves the Eurozone. 50-50 this year if they leave the Eurozone. If they leave the Euro and they go back to the drachma, that's about a 50-50 coin flip right now. I think I'm a little bit on the higher end than a lot of other people are, but I see tremendous risk there. I see, and the problem that the Greece government is really faced with is if they agree to the austerity stipulations that the ECB and the IMF and the Eurozone are placing on them, then they're no longer going to be in government, guys. That they're going to be voted out. That's what they're faced with right now. If they agree to these austerity problems, because it was just 6 months ago that they fought for election that on an anti-austerity campaign. And so that's kind of what we're seeing right now. It's going to be tremendously uncertain over the next few weeks, and especially this week in the market. Expect tremendous volatility. And you have, and this is the unemployment week. You have the unemployment report coming out on Friday of this week. You have consumer confidence numbers coming out tomorrow. You have manufacturing data coming out here in the U.S. You had home housing data come out today that was also a negative. So you're looking at tremendous uncertainty right now. Now, in terms of let's talk in terms of retirement accounts. The name of the game in every capacity is protection. That is the name of the game in every capacity. Protect your capital, protect your currency, protect those retirement accounts. Consumers in America and everywhere else, they work years, if not decades, for the retirement, and they treat it like it's nothing. They protect their cell phones, they buy insurance on their house, their cars, their life, their health. They literally insure every aspect of their life except their retirement accounts. And I've been talking about this for a very long time. If you have a retirement account, you need protection. And you don't wait until it's already tanking, because if you wait till it's already tanking, then the volatility index, otherwise known as the VIX, starts going up tremendously. For example, the VIX just today is up 22%. Just today. Volatility in the market up 22%. So just today, if you waited just one day to buy insurance for the retirement account, you're already paying more today to protect that than you would have, say, last week or whatnot. It's much cheaper. It's much cheaper to protect the account today than it would, last week than it would be today. And how we protect that is always put options. Buy and put options on market-related indexes, making sure that we're insuring those retirement accounts, because many of those retirement accounts are in mutual funds or market-related ETFs, but they're all bullish type positions. So you have to protect them with insurance. Now what I want to show you guys is the impact to the currency market, because the impact to the currency market was utterly unreal. What happened at the open yesterday. Typically speaking, we do not see gapping situations on anything out there in terms of currencies, not on the major currencies. But when we're looking at a couple major pairs here, here's the euro dollar. Okay, euro dollar closes on Friday at 1.1150. That's $1.11 and 50 pips. The very next time it opened, it went down about 200 pips. Okay, now that's about 2% on a currency, which is a tremendous movement. And then obviously you've seen it come back up. Many people, myself included, if you were short on the euro, this is what you call a gift. Okay, this is what you call a gift, and you immediately get out of it. You just take the money and run. That's a gift. You take the money and run, because look what happens back to it. See, what they don't understand is that in the currency market, especially with the euro, there's going to be people And when I mean people, I mean large institutional banks. I mean central banks that are going to fight to prop up the euro in this environment. For example, the Swiss National Bank will fight to keep the euro up because they do a lot of business with the European Union. They do a lot of business in terms of international trade between the Swiss and its European neighbors. And so you'll see these large institutional banks, these large central banks, will fight to keep certain levels up. And so as you can see, it filled that gap. Now I'm looking at it again, and I'll talk about this in the currency market later. But I still like a short position on the euro. It filled the gap. We'll kind of see what happens outside of that. But that was what happened on the euro. On the pound dollar didn't gap down as far because obviously the pound is not directly tied to the euro. It did drop back down. I was personally long pound US dollar coming into this moment, and I actually kept my trade on. So I saw last night the euro and the pound really struggled, in terms of that. Euro got beat up a little bit more. Pound went down about 150 pips as well. But what I saw was a little bit of slowing momentum here. It started coming back up. I put a stop loss right underneath this level intraday, and obviously it's responded very, very good. So, having basically your experiences, your trading experience, everything can help you adjust certain things. But the one that I was very concerned about was this one. I was also long US dollar, Japanese yen. And so in the open, when it happened last night, I was short euro, that was good. I was long dollar yen, that was bad. I was long pound dollar, that was bad. And so I got beat up a little bit coming into the open last night. But it's how you manage, guys, because I turned a losing situation into a winning situation. I went short on the dollar yen right here. Do you see how it comes back into this old support zone? I went short on that downward movement. I pulled the trade off right here, just literally right before I got on the lab. I pulled the trade off right there because it's slowing momentum. Again, having the ability to react to these environments can turn losers into winners. And right now, I've had a very good morning in terms of trading. Not exactly a good 5 o'clock Mountain Standard Time yesterday when all of this kind of went down. But it was a very interesting movement in the currencies. It's going to be interesting movement in the dollar. It's going to be interesting movement in the marketplace as a whole. Crude oil kind of got beat up a little bit. Nothing too bad, I would say. It did kind of get beat up a little bit on the open yesterday as well. As you can see, the gap in price right there starting to sell off a little bit. Currently at 58.49. If you're trading crude, guys, it did not break the neutrality. Okay, the neutrality really goes from about 57.5 up to about 61.5. So you got that 4-point range where you have tremendous neutrality there. So if you're still trading crude, it's still neutral. Naked puts are still good on crude. If it does break 57.5, we got to reassess those naked puts. We got to reassess any long crude positions in that capacity. In terms of the dollar specifically, looking at the dollar index. Obviously, it responded good, okay, at the open yesterday. It responded good, but then it started coming right back down in price. It is still in that range too. I kind of like the dollar right now at this intraday support level. As you can see right there at about 95.25, you have lots of intraday support levels. That's kind of where it is right now. I see very little risk. If you're wrong, you got a stop loss literally a couple ticks down. Very little risk in terms of that. We'll talk more about that in the dollar index when I do the forex report later on this evening. But in this times of uncertainty, guys, we don't know what the future holds. Nobody does. Nobody knows what the ECB is going to do. Nobody knows what the IMF is going to do. Nobody knows what the US is going to do. Nobody knows how the Greeks are going to vote on July 5th. It's very, very uncertain right now. You're gonna have some people be doomsdayers out there. You're gonna have some people, say that the Fed is gonna save the day. You're gonna have a lot of information. Let's trust price action more than anything else. Let's trust price action, because it's that price action in the marketplace. It's the price action that is really going to tell us where this thing is going to go. And right here, looking at the ES contract again, you did break intraday support levels, you did break daily support levels, and it's going to be an interesting beast if it can get above this 2070 area again. Right now it's at 2067. 2070, in my estimation, is a very important, significant number for the market in terms of the S&P 500. If it can get back up above 2070 by the end of the day, we're still neutral. If it can't, there are going to be some, myself included, that will switch to more slightly bearish. Your next level of support that you have to deem worthy is down here at 2040. That is going to be your weekly support level as well. So if you switch this to the weekly chart here, okay, if you switch this to the weekly chart here, you have support there, you have support here at 2000. Ultimately, in my estimation, it's the 2000 number that is the most important number to the market. It's that 2000 that is a significant whole number. It's been old support back here in October and early November, December, early January. It was old resistance back here in August. And so really kind of on this weekly levels, you're neutral long term until really between 2000 and 2150. So you got about 150 point range of neutrality. I don't think myself would ever go bearish until 2000 is broken. Right now I'm still maintaining neutrality, but it's going to be an interesting hurdle over the course of the next little bit.
Get off the sidelines and take control of your financial future at www.tackletrading.com. Get in the game.